Okay. Yeah, just as things are coming on. First of all, very good morning. It's morning here in the UK. Good afternoon or evening, depending on where you're from. Looking forward to taking us through this session. It's an interesting type of session and an important one, really, today. And arguably, it's one of the most important lessons in trading. It's what to do when essentially there's nothing to do. I shared yesterday in the Forex Source terminal. There's a book called New Market Wizards, and in that book there's a quote from Jim Rogers, which is very helpful, where he said that he just waited until there's money lying in the corner, and all that he has to do is go over and pick them up. So this kind of ability to do nothing when nothing's around is really one of the learning curves and learning points from these last 2 days. So normally when we start this webinar, we look at the dominant currency sentiment that the market is focused on right now. And the market is very focused on something right now, but it's a future event which is just resulting in volatility but uncertainty in the meantime, and that is the FOMC rate decision this evening at 1800 GMT hours. That has been the focus of the market since the non-farm payroll on Friday. And myself and Arno were chatting about this as soon as we had the NFP data released, looking straight ahead to what the Federal Reserve would do on Wednesday, because that was obviously the next key crossroads in this US recovery, possibly, story. So that's exactly where we still are today, looking ahead for the FOMC. So I'm just going to take us through where we're at and why, just so you can see why the market is in this state of kind of confusion, or rather inaction ahead of the FOMC. Just going to explain that. So obviously, first of all, we had the very good data on the non-farm payroll, and I will be talking during the webinar about what we expect the Fed to do and what reaction we expect that to have and which currency pairs to trade it with. We will be looking at that in the next sort of 10-15 minutes. But first of all, I just want to put it into some context so we can understand the current market environment, because we've got a number of questions in the back end, just people asking, what should I do? Should I be trading now? Should I not be trading? Trying to get in. Some people trying to force trades. Other people thinking, well, should I just be doing nothing? So I just want to explain that this is a market in which to be patient. This is a market in which you can give back the profit that you've worked hard to achieve. And so just waiting, because clarity is going to come. And it's going to come by this evening when the Fed makes the next move. The market will have the next narrative to run with. So with that being said, I just want to explain a little bit of the context of the confusion. Now, we obviously have the non-farm payroll data, very strong data. And it raises the question for the Federal Reserve. What are they going to do? Are they going to acknowledge this good data? Are they going to become more optimistic? Are they going to become concerned about the rise in 10-year bonds and try to artificially keep those bonds down? We'll look at that later. So since then, we've also had some further data, which really raises further question marks. So Germany, the largest country in Europe, the biggest contributor to Europe. So German data has a significant impact on the movement of the euro. Their trade balance data was very low. It was 3.2 billion, and you can see that was below the minimum expectations of 4.5 billion. So a very low figure, and that was the lowest figure for Germany's trade balance since 1990. So that just shows you how poor a trade balance that was for Germany. And obviously German manufacturing German exports, very, very strong market. So that's that was a concern for the market, and that sort of turned the market a little bit risk off on 9th of June, yesterday morning. But later on in the day, we also had GDP for the Eurozone, which was revised up. So you can see that quarter on quarter was expected minus 3.8, year on year 3.2, quarter on quarter revised up minus 3.6, in line with the maximum expectation. 3.1% up year on year, revised up in line with minus 3.1% maximum expectation. So that was a better than anticipated result for the quarter one. It is historical, but the fact that it's revised up just plays into that narrative that COVID-19 is not going to affect us as bad as feared. Okay. Then had US data out, and the US data was back in line with poor German data, with wholesales month on month minus 16.9%, one of the worst months on record. So a very poor data point out of the US. So we now are heading towards the FOMC event this evening. So it's we're in that state of flux, just waiting to see what's happening. What we have been seeing the dollar weakness going into the event. Dollar's just been weakening. So we had the non-farm payroll data out on the 5th of June. We saw some dollar strength initially, and the dollar has just sold off since the non-farm payroll. And this has been on concerns that the Federal Reserve is going to have to impact yield curve control. Now, what is yield curve control? Let's just take a look at our bonds prices here. You can see here, this is the yield for the US government 10-year bond. Now, one of the concerns of the market has been this breakout of this level. See, the market's broken out of this 0.75 level and has just pushed higher up to the 0.94 level, and is since pulling back. Now, a lot of the different stimulus packages that the Federal Reserve and other central banks have put into place have increased the amount of the country's debt. So the debt to GDP ratio has gone up for countries across the whole world, as countries across the world are saying, we want to support our economies through the COVID-19 shutdowns. So you've had furlough schemes, you've had small business schemes, you've had governments across the world helping out in multiple ways, and all of it has cost an enormous amount of money. So as a result of those extra debts, if yields go higher, it means the cost of servicing that debt increases. Now, no central bank, no government wants their debt costs to go up. It's a bit like if you have a mortgage on a house, and you don't want your mortgage provider to start putting up your repayments and upping your percentage. So what the one option open to the Federal Reserve is to artificially keep government yields low, so they can use it to keep government yields at a certain price. So for example, Australia on their 3-year bonds want to keep it at 0.25%. Japan on their 10-year bonds want to keep it at 0%. So other central banks have employed this method. So the potential here is that it's something called yield curve control, is that the Federal Reserve puts yield curve control into place to keep their borrowing costs down. That is the concern. That is why we've been seeing the dollar weakening in anticipation and potential expectation that that's going to be in place. We've also seen yen and the Swiss franc being heavily bid into the event. So risk is very, very elevated, and that has been the dominant sentiment that's been going on. Now, this dollar weakness has just pushed the major currency pairs higher on the dollar weakness, as you'd expect. And we've seen the yen and the Swiss franc have outperformed the US dollar, and we've seen a decoupling from the US dollar, Japanese yen, and Swiss franc. Remember that for the last sort of few weeks, we've been seeing the US dollar operating as a safe haven currency alongside Japanese yen and Swiss franc. We've seen that decouple a little bit. So you've seen greater strength in the yen and the Swiss franc and weakness in the, let's turn this walk off, and weakness in the US dollar. So that's something to be aware of. And it's going into this FOMC event, which is causing this fluctuation and this temporary partial decoupling, at least, movement of the US dollar in relation to safe havens. So we don't have a dominant currency sentiment pair to be trading with at the moment. Because of this uncertainty with the US dollar, and because of the potential for some position squaring going into the event, as well as there isn't a clear driver in these markets. There isn't a clear picture. So when the FOMC event occurs, that's when we're starting to get some clarity, and then that's when our next trade opportunity will emerge. So the good news is that the FOMC should provide some good opportunities. So let's now look ahead to what's coming. I hope you, I hope you can understand the broad picture. And I hope you can understand why in this context, with so much uncertainty, it doesn't make sense to be getting into any intraday trades. Now, this could be opportunity for some swing trades or longer position trades. Even some speculative trades are possible going into the event. Obviously, you are taking more risk with a speculative trade because you don't know what's going to happen. But in terms of intraday activity, I hope this shows you, if this is like a learning point for you or a new market, you think, actually, well, this is why it doesn't make sense to be jumping in and out of this market because of the uncertainty that's been going on. And it's why it would make sense. Just wait the FOMC event. Don't get stuck into a trade. Obviously, there are headlines you could trade at the moment. So, Brexit headlines, if there was either very negative or very positive Brexit headlines, that would shift the pound. Any very negative US or positive US-China trade negotiations, that would move risk assets. Similarly, along with anything Australia and China trade related. So there are headlines around that could be traded, but at the moment, this mixed and confusing sentiment is at the forefront of traders' mind, and it was ever since Friday. That was the key moment, a potential turning point in the crisis. Now, let's look ahead to the risk events that are coming ahead. So first of all, coming up here, just to mention, we had the private inventory, and we saw a surprise build in crude stocks. So that's something to be aware of. We'll cover that in a minute. CPI data. Now, CPI data is coming out this afternoon. Now, normally the core CPI data would be very important for the US economy. It's less important at the moment because the FOMC is by far and away the more important meeting, and it's going to overshadow what happens with the CPI data most likely. So not expecting much movement here, and we're not expecting any tradable opportunities from the CPI data coming out at 1:30. Now, for oil traders or anyone trading CAD, there is the crude stocks data that's coming out. Now, we have had a surprise build of 8 million barrels was registered by the API, the private inventory data, last night. So the expectations for today is a draw of minus 1.7 million barrels. Now, if we get a large build, above 3-4 million, that will be negative for oil prices and negative for CAD. So look out for that. Potentially, there could be potentially a trade with CAD, depending on what's happening with risk tone, if we get a big deviation. But I say potentially because the FOMC is still looming ahead. So you may get a muted reaction even from an unexpected crude data. Now, minus 5.63 draw in inventory would be positive for oil. If you got a greater than minus 5.63 draw, that would be positive for crude stocks and positive for crude prices and positive for CAD. So that's something to be aware of. Potentially US dollar CAD would be the pair to look at. If we got a large draw, that would be positive for CAD. We're seeing US dollar weakness, so that would likely result in further US dollar CAD downside. Possibly a trading opportunity there. Let's just have a little look at the chart. Yeah, so the possibility there would be a break of that trend line if you just got a very, very greater than expected draw. You'd expect US dollar weakness, CAD strength, and a break of that trend line down into the ADR low. It's pushing it, but that's possible if we got a greater than expected draw of stocks, so greater than minus 5.6, so minus 6, 9.7. Unexpected, the risk is towards a build because the private inventory data yesterday showed a build in the data. And if we just take a look here at here, you can see the picture since the start of the year has been for a build in inventory, obviously, and that ties in with what's happening in the oil market, falling demand, over supply. So with that surprise build around 8 million, that's going back high again. And you can see we've only had a few draws in May. So that's something to be aware of for oil prices and for CAD, and probably the best pair for if there's a draw greater than minus 5, that would be potential for a US dollar CAD short break of that trend line, moving down to the ADR. Low of the day would be an obvious opportunity. Now, obviously, let's now go to the main event. And the main event is the FOMC rate decision. So make sure that you have a look through our daily risk event outlook. It's under the must read tab. And you can have a strong look at this going into the event so you're prepared for what might happen. And in particular, just take a look at this section here under the FOMC rate decision, policy statement, and press conference. So you can see the explanation of what's going on. Now, this is what to roughly expect. If we get yield curve control, so just looking at this section here, I'm just going to make this a bit larger here. There we go. Right. If we get yield curve, so I'm just going this sentence here. If we get yield curve control, and the Fed says, the quantitative easing program is going to remain the same, and we're going to keep up with our stimulus, then that's likely to be a double negative for the US dollar. So in that environment, we would expect US dollar weakness. Now, it's also worth mentioning, if that happens, get yield curve control announced, Fed keeping QE program the same, we get US dollar negative, and we'd expect more upside in gold. So just taking a look at gold prices on the daily chart, you can see price tried to break through that trend line, and as prices broken and closed above. So as long as we're above this trend line, the bulls are in charge. So you would expect, if the Federal Reserve announce yield curve control, keep quantitative easing the same, you'd expect a test back up to that 1750 level. So that will be a first target for buyers in that environment. So be aware of that. So this is yield curve control, quantitative easing remaining the same. I'll show you where it is. I'll show you where it is in the report. So then, after the webinar, you can go back to it. So that is this outcome here, from if to expectations. That's the first outcome. Now, this is the second potential outcome. If the Fed does announce yield curve control, but say it's more flexible on the quantitative easing program, and it's more flexible on the other additional liquidity tools like swap lines, that would be a dollar positive in the short term. So in that scenario, we would probably look at something like the dollar yen. So the dollar yen would be the potential there. Now let's just look at where we are on the dollar yen. We have that. Yeah, so in that environment, we can see that descending trend line that's just being broken, okay? So in that environment, we'd expect this ascending trend line to hold and to price to move back into that range. So in that situation, you would look at potential buying at market, just stops underneath probably the low of the day, underneath that low, that 107, playing back into the range, you know, playing back up towards that 109, 109.50 region. That would be the target for that scenario. And that's in the scenario where you get yield curve control, but the quantitative easing is flexible. Okay. Now, a stronger version of this would be if we get no yield curve control and a more positive outlook. Now, this is tying in with that strong NFP data on Friday. I can't think of any data point that has got so many analysts and economists wrong-footed. So either something was wrong with the way the data was collected, or the situation is entirely different than everyone is expecting. So that is the risk here, that the Fed turn around and say, yeah, we were expecting a dire outlook because of COVID-19, but actually, you know, the non-farm payroll shows that the labor market is still growing, you know, despite all the difficulties we're in. So we're not going to have yield curve control. We've got a totally more positive outlook for the US economy. Then that would be strong dollar upside. So again, same as before, that would be a potential buy at market, stops above and just playing up to, you know, playing up to that 111 level would be the next obvious step on that. But, you know, you expect to pause a bit of profit taking at 109.50 and then moving up to 111. Alongside dollar yen longs, you could also consider euro US dollar shorts. That would be, just taking a look here. Again, you can see similar kind of trend line in place. So it would be just selling at market, stops just above that trend line, above that 1.1400 handle would make sense, playing down to the bottom of the range, 1.0800. So that is in the scenario of no yield control, no yield curve control and positive outlook. So just looking here, yeah. So don't forget to have a look here in this daily risk event outlook so you can get yourself prepared for the event. This is one of those events you need to be prepared for. So when the data comes out, you know what you're pulling the trigger on. Expect a lot of volatility and expect some movement coming up later on today. Now, that is quite a long introduction today, but it's needed just to make sense of what's going on. So I hope that's been helpful, giving some context. And if you have been confused over these last couple of days in the markets, just to explain that that's very normal to be confused when there is so much uncertainty out there. Your confusion is really just mirroring the confusion that the market itself is feeling. So if that has been you, don't be disheartened. That's just trading is like that sometimes, and this is one of those times. So now I'm going to get through to the questions and the answer panels. So I'm just going to work my way through the questions there. Yeah, good morning, Carlos. What should happen if Fed does not announce yield curve control today, but signals will be introduced soon? Yeah, that's a good question. I think if it signals yield curve control that it's coming, I would be looking at that as a US dollar negative. Okay, so that's how I'd be looking at that, if it signals it coming soon. And the market will obviously be looking forward, Carlos, to try to see, be looking at that dot plot, and it'll be trying to, work out, exactly what's happening. So do take a look at that. Anant, good morning. Can you let us have your view on how you expect the equities and the dollar to behave if the Fed does nothing but reiterates the infinite QE, or they go for the yield curve control, and how you would trade these options? Yeah, the only bit I haven't covered, Anand, is the stocks. So if you get yield curve control plus quantitative easing, you'd expect stocks to rise. Okay. If it's no yield curve control but more positive outlook, you'd expect stocks to fall. Ashley Webb, would it be that trader desks are taking a break to come back later for FOMC? Yeah, it's just that traders aren't wanting to initiate a new position. So there may be some positioning ahead of the event, Ashley. And it's not that like people won't be at their desks necessarily. Obviously, COVID-19 does change things at the moment. They're probably most desks are probably running a skeleton staff at the moment, but there will be an anticipation and waiting for the event. So that's what tends to happen in these kind of events. Actually, the range is narrow and narrow and narrow ahead of the event. Now we kind of saw that on Monday. Like on Monday, we started seeing these sort of, it's been quite a narrow range really. If you just take, you see here on the 8th. Just had this narrow kind of range, and then out of the range and back into the range, and now back in. You've kind of got this nothing trade with, price is roughly the same place it was at the start of the week. So you kind of see that kind of thing running up into these big events. Will yield curve control introduction affect the QE program currently in place? Well, that's the question people are wanting to know. Carlos, if it's yield curve control but quantitative easing remains the same, then that is strongly US dollar negative. If it's yield curve control but the QE program is more flexible, then that would be more likely to be US dollar positive. Paul Jefferson, what would be a tradable CPI number? Yeah, it's really, that's a good question, Paul. My looking at the CPI data is I don't think it's going to be tradable. Now, core CPI is 1.3% expected, maximum is 1.5%, and minimum 1.1%. So for a potential tradable opportunity, look for something outside of those minimum and maximum expectations, so a big surprise. So on the core data is the data you want to focus on. So if you get a big movement outside the minimum maximum expectations, that could potentially have some impact. But because the FOMC is such a big event, it would have to be quite a large move to have any kind of impact really going ahead. So by all means, take a look at it, but remember that the FOMC is the big event of the day, and this is a smaller event. So again, anything outside the minimum maximum expectations would be potentially tradable, but I wouldn't, just purely because the FOMC is ahead, so it affects the commitment that traders have to the position. Yeah, hi Dudley. If the Fed wants to implement yield curve control, then that would reduce longer term debt repayments, yes. Yeah, would that not be positive for the US? And therefore, should it not strengthen the dollar? Yeah, Dudley, what it is, this is basically the reflation trade. So because the US economy is recovering, then people can get rid of their US dollars and they can start investing in equities, they can start investing in Australian dollar, New Zealand dollar, they can start pushing. The US, remember, is the largest economy in the world. So once the US gets going, everyone else gets going, okay? So it's one of those strange ironies, Dudley, that when the US is struggling, the US dollar rises, okay? Because everyone brings their US dollars back, everyone wants their cash in US dollars, there's a great demand for dollar. So when longer term debt repayments, then that gives the market reassurance that, you know, okay, this party is going to carry on. That would be, you know, if QE remains the same, then you can start, you're getting shifting that US dollar out into other riskier assets. So it's not a daft question at all, Dudley, that one. It's an insightful one. Rolando, hi. Yeah, as I understand, high bond yields are good because it looks like investors are preferring to go for equities instead of bonds. By the end of 2018, the 10-year yield was around 3% and the market was comfortable with that. When you say about keeping yields artificially low, doesn't it send the idea of the government needing more financing and therefore negative for equities and investment goes more to bonds? Hope I made myself understand. Thanks. Yeah. Rolando, I think longer term, ultimately, that would be the case. But that would be longer term down the line because the US government isn't struggling. You know, it's the largest economy in the world. They're able to finance their debt comfortably. You're right. If it was like a struggling emerging market and they were, you know, desperately trying to keep their yields low, doing everything they could, you know, trying to pull out every trick in the book, say in an emerging market, then the market would see through that. At the moment, the Fed has enough firepower to still keep yields artificially low without it setting off investors' alarm bells that the government is going to default on its debts. You know, you think of Japan. Japan have been doing this for years, and no one's thought, you know, Japan can't pay their debt off. Japan's struggling despite their large debt to GDP ratio. So I think Japan, you know, just have a quick look sometime at Japan's debt to GDP ratio, and you'll see it's a lot higher than many other countries, but they haven't set off investors' alarm bells. So, Rolando, you're right. Yes, longer term, if it kept going up and the US was struggling to finance its debt, but at the moment, it's not the case. Oh, Tobias, how can I get the ADR? I don't find it on TradingView. Yeah, I think it's, right, we've got it here. I don't know. We've got it here, average daily range. I don't know if that's because it's been someone who's given it like in. I'm not sure. That looks like a script, right? I'm not sure in short, Tobias, but if you maybe search this name, Jorge Silvestrini, perhaps he has given the script for the average daily range. So if that's the case, have a look, and I hope that helps. Aside from that, I'm not sure because I just use it here. It's just in the favorites. But I hope that. If you don't find it, Tobias, just give support an email, and I'm sure they'll put you on the right lines. Sergey. Hi, Giles. Did non-farm payrolls wrongly counted by 4.9 million? That's what I've read in some online sources. Yeah, Sergey, you know, I've picked up this odd rumor as well that the non-farm payroll was wrongly counted. There's certainly a lot of uncertainty around it. I haven't seen it been getting wide circulation, Sergey. So even though I've read some of the same sources by the sounds of it, I haven't seen it getting wide coverage. Like I haven't been seeing it on the Bloomberg terminal. I haven't been seeing it on Reuters. So I'm not sure what to make of it, really. It's certainly not widespread. I think if it was widespread, Sergey, it would be bang up there. It would be all the Bloomberg analysts would be talking about it. It would just be, focus. So certainly not focus, but does raise some interesting questions. I'm confused as to how economists and analysts can get that so wrong. It does seem confusing, and there does seem to be some issue with accounting. So I think it's one thing to keep in mind for sure. Joyson, I don't really understand fully about how the yield curve control worked. You gave an example about the house mortgage, but I did not fully get it anyway. Could you please explain again with another example? Yeah, sure. Right, let's have a look. So this is the yield for the US government bond, okay, for 10 years. So when the US government wants to borrow money, they issue a bond and they say, you lend us the money for 10 years, and this is the yield we'll pay you each year for the bond. And it's 0.79% at the moment, okay? Now, when it's yield curve control, what the government does is they say, right, we want, say they said, for example, we want to keep this at 0.79. So the way to keep a yield in place is by buying or selling a bond. So in order to have yields go up, you need bond prices to go down. And if bond prices are going up, then yield prices are going down. They move in opposition to each other. So all that happens in yield curve control is that the Federal Reserve will time the purchase of their bonds in order to keep the yield curve, yield at that certain level. So they might say, we want to keep the yield at, so let's look with Japan. You see, they want to keep the yield at around 0%. Okay, so here it is. It's just around here at 0, just above 0. And the Japanese government are buying bonds just to keep it around that level. So as the market ebbs and flows, they adjust the rate purchase of their bonds to their quantitative easing program to keep the rate at a certain level. That's all they're doing. So the very simple way of understanding it, Johansson, is that the Federal Reserve buys bonds in order to keep the yield at a certain level. It's as simple as that. I hope that makes sense. If bonds are new to you, just take a little bit of time. We've got some stuff on the Forex Source terminal just explaining how bonds, yields, and bond prices work. It's one area that many FX traders kind of just leave till later, as it were. So it's a key thing to look at, because bond prices and bond yields impact interest rates, and obviously interest rates is of key interest for us as FX traders. So it's that relationship between bonds and interest rates is that we're interested in. Tobias, I was watching when is the best time to take swing trade entries from the video library, and you're talking about a pure technical entry versus a fundamental entry, and you wait for the short-term sentiment to realign with the fundamental approach macro. Could you give us an example of that? Yeah, let's have a look. Yeah, let's have a look. So let's look at the pound New Zealand dollar. Okay, so pound New Zealand dollar. Okay, here's an example where you've got like a bearish bias on the pound New Zealand dollar pair. Okay, we've got Brexit concerns weighing on the pound. UK has until the end of June to extend its EU-UK trade deal. Okay, if it doesn't do it, that's very negative for the pound. Hard Brexit, pound selling. New Zealand dollar is opening up its economy. It's been declared COVID-19 free on June the 15th. Its economy is getting back to a business. So we're expecting New Zealand dollar strength. You can see over the past few weeks that dichotomy between The UK struggling with Brexit and COVID-19 cases high. New Zealand opening up its economy has just led to pound New Zealand dollar downside. So that's your fundamental bias, right? Tobias. So then looking, how do you get into that? So there's different ways. So you might think, well, you know, I'm looking at a swing trade. So if I'm looking at a pure swing trade, I might be looking just up towards, well, let's see, I might be looking up to this 1.9750 region, just up here, just stops above the high, looking for selling at this kind of supply level. That would be an obvious place where I'd expect sellers, as long as the market condition remains the same. Another way you might think, well, you know, if I just want to look at this technically, you might think, well, you know, I'll look to be selling this pair whenever I get an opportunity. So you might think, well, look, I'll just put a, you might think, oh, I'll just put a trend line in place. Okay, so I just got a trend line in there, and just do it from there, you know, and you might think, well, you know, if I get a break of that trend line, I'll consider an opportunity to short. So you might think from a purely tech, you know, a very technician's market, you might say, okay, well, look, you know, you would have thought, one technique that I think is helpful is you got this trend line here. You might say, well, I'll sell on stop, and I'll put a little tight stop in, you know, 20 points. So you might think, well, okay, I'll sell on stop here. I've got a tight stop of 64. So okay, I was taken in, knocked out the trade, and then taken in the second time, and either knocked out or kept in that one, and then might try 3 times, and then you just might take a move down, you know, take 50 points, move the second position to break even. That's a kind of example. Okay. Do you think in the future Forex will be gone and we will have only one world currency, crypto? They say that all fiats eventually fail due to losing their purchasing power. I heard that the dollar has just lost around 90% of its value, but why can't they just do quantitative easing tightening then to make the value back? Tobias, who knows in the future? For now, I think currencies are here to stay. We're not just going to get rid of currencies. You're certainly not going to get rid of the US dollar, you know, euro, pound, yen, Swiss franc. There's far too much incentive to just get rid of those currencies at the moment. But, you know, that kind of thinking, Tobias, does lead to gold bulls. You know, there's a number of people who I see making a very strong case for the long-term value of gold. So that's that kind of thinking. But I don't think Forex will be gone anytime short now. Lucas, I have long pound New Zealand dollar, and I wonder if I can hold this position during the FOMC meeting. If the FOMC will be very positive, no yield curve control, and flexible with QE, how will this affect New Zealand dollar and the pound New Zealand dollar long? I've targeted at 1.1975. So targeting 1.1975. Yeah, and stop just below 1.94. Yeah. So if you get no yield curve control, flexible with QE, that would be dollar positive. Now, if we see dollar positive, we'd see New Zealand dollar downside, and we'd see pound downside on the weakening US dollar. So in that scenario, I would expect the pound New Zealand dollar to remain range bound. I don't see much positive sentiment for the pound is my concern on this one, Lucas, because we've got Brexit concerns, COVID-19 cases, and then you've got New Zealand opening up their economy. You can see that there's been one-way traffic here. So holding through the FOMC event, no one knows what's going to happen. That's the problem you've got with trading through the event, Lucas. So as long you can do it, of course, and as long as you're prepared and you've managed your risk and you know where you're getting in and where you're getting out, it's fine to do. but you just have to be aware that it's a speculation and there's a lot more risk than waiting for the event. Yeah, David, do you recommend enter at market with the fast money after the initial squawk announcement, presuming there's a clear shift? Are you going to wait until the presser at 7:30? Thanks. Yeah, David, it will be just waiting. So if like it's no yield, if it's yield curve control and quantitative easing remains the same, I would enter in, you know, euro US dollar long or a gold long. That makes sense to me. And with the presser, it depends. So it depends. If it's like a real clear shift, I'll hold through the presser, but just keeping an eye on what happens at the press conference, because the press conference can reverse the decision, you know. So it would depend as well how big the shift is and how much profit you had. I'd probably want to take some profit on the initial announcement anyway, and then wait for the press conference, and then pick everything up again tomorrow and see what the new lay of the land is. Okay, if it's like Carlos, no yield curve control, no changes to QE swap lines currently in place, then expect a bit of a muted reaction, Carlos. It should just be quite muted. Cortez, what's your view on Aussie and New Zealand dollars since their economies are reopening? Yeah, they've been the risk-on trades, haven't they? Aussie moving higher, New Zealand dollar moving higher, and their economies are reopening. That's positive for them. So, you know, medium term, bullish Aussie and bullish New Zealand dollar. The only concern here, Cortez, is they've been quite extended on the risk-on trades, and there's a bit of technical selling and a bit of profit taking. Tobias, what's correlated to the Norwegian index? Could I trade it as a risk on, risk off? I checked out what companies in Norway 25. Of course, Norway's biggest 25 companies, and all days were either oil companies or fish salmon companies. So if I can monitor US dollar NOK, see the risk tone for the day or something else. That's a good question, Tobias. You know, I'm not, I am not a big NOK. I'm not very clear on NOK. I'm just seeing, like, I know of a good resource for you. I'm just having a little look here. Just bear with me, and I'm going to try and find you a resource which has quite a lot of NOK. Yeah, now this is Tobias. If you look at Nordea Markets, they really specialize in the NOK, and they will have something there for you, particularly on the Norwegian index and what's going on with NOK. Obviously, that close correlation with oil is the obvious one. Norwegian kroner moves with oil, and I'm sure you already get that. But in terms of the finer points, check out Nordea Research. I think you'll find that helpful, Tobias. If you send me another message, I'll type in the name for you. I can't type it in now because when I press answer live, it doesn't give me the option to go back to it. Honzo, yeah, have you considered starting a live webinar during the time of high impact news release, like last week's and possibly to? Yeah, that's one interesting question. Yeah, Honzo, well, it'll be one for us to think about whether it's worth us actually putting up a live one. If people would like that, just get in touch with us. Hi, Jehosim. I have a question about the trade ideas you're posting in the trade ideas tab. How can I know or reassure that a trade idea is still valid once the price getting close to entry level? Yeah, and I do understand that it's valid as long as the rationale is in place, but how can I make 100% sure that the rationale indeed is in place? Or should I consider it to be valid no matter what in the time horizon? The institutional trade from yesterday, TD Bank, has no time horizon or anything like that. So the same question goes here. How can I make 100% sure that TD and or Forex Source still thinks that sort of trade is valid? Yeah. Well, number one, if you know, if there's no trade idea, okay, if there's no rationale, like it was at TD Bank here. Let's see what they've put. So, Nate, okay, we're wary of the optimism around the improvement in the second derivative of the global reopening from lockdown. In other words, the rate of change has improved, is no longer declining at such a rapid pace. We think the risk reward favors fading the price gaps in these G10 crosses, especially with US dollar positioning flat and G10 FX quite expensive. So they're shorting New Zealand US dollar, and they're just kind of, they don't quite buy into the optimism about the reopening. So it's a simple, that scenario, Jehoshim, is as simple as, well, if the optimism is warranted, then this trade idea will become irrelevant. If, you know, the optimism was misplaced, and we start to, you need to see things like growing death rates, more countries shutting down again. You know, that's the sort of thing that would weigh on risk. So it's really quite, that's quite a speculative trade. So first of all, that's speculative. They're just saying we're wary of the optimism. Doesn't give any reasons, just doesn't quite buy into it all. So it's a more, that, in my book, this is a speculative trade, okay? Alongside some observations on US dollar positioning. Now, in terms of our other trades, ideas, forex source ones, here's pound New Zealand dollar. So here, as long as the UK has still to agree at EU-UK extension, then you'd expect pound to be sold. And with the New Zealand economy opening up, that would be great news for the New Zealand dollar. So that's why you could keep expecting pound New Zealand dollar sellers. Now, you know, you can look at this different ways. See, when you've got that, remember what I was showing, when you've got that bias, you can go into the pair and say, well, okay, you know, I'll look at shorting, you know, every 4-hour trend line that breaks. You might draw a trend line there, short that trend line here, short that one, trend line there, short that one, trend line here, short that one. You can look at it like that, or you can look at, well, I'll wait for a deeper pullback into this supply level, and I'll take a longer term trade. I'll just put my stop above here and play for a larger leg lower. So again, it's just, Joseph, you're never going to be 100% sure. There's always been a little element of doubt in trading, because everything's live. You know, the UK and the EU are constantly having negotiations. At some point, they might make a deal. The New Zealand economy is obviously getting up and going, but we don't know that there won't be another case. So it's just, it's moving. You're never going to be 100% sure, essentially, Jehoshim. There's always an element of doubt, but you're monitoring it. So when that element of doubt becomes, it's no longer a doubt. So, you know, if the UK agree a trade deal with the EU, you know it's clearly invalid. Or, Jehoshim, maybe it's a bit grayer. Maybe Boris Johnson says, oh, looking forward to arranging a trade deal next week. You know, that would be optimistic, and that would invalidate it as well. What's your view for the COVID-19 second wave? And if it does happen, what can the Fed do to sustain the economy? Yeah, Spanish flu, they had 2 waves, 3 waves. Second was worse than the first. Will we get a second wave? Don't know. Governments are preparing for it, expecting it. It could happen, but it equally could not happen as well. So I don't know whether we'll get a second wave. Viruses are different. SARS, MERS didn't get waves of it. Spanish flu, you did get waves. I know COVID-19 is closer to the Spanish flu than SARS and MERS because of its infectiousness. So if there is a second wave, then expect more, you know, movements from the Fed to do everything they can. They'll just try to, that opens up negative interest rates, and that would be a clear gold buy in my view. Jimmy, hi, I did see on the newsfeed there was a reference to FX options. Did this reveal anything significant to us? Okay, Cheers, Jimmy. Options levels, euro, US dollar. So what it does, it tells you that when there is a video in the feed. I'll just put a question in the feed and we've got a video on this. But it tells you that at this level here, there's an option expiry level. They're valid till 3 o'clock GMT time. And they're levels that you tend to see strong defense of. So you can see here this 90-95 level. That most likely, this will see it like a support and resistance level. So you don't know whether it's a buy or whether it's a put or a call option level. You don't know whether it's a buy or a sell, but you know it's significant. So you can see some reaction just off before that level now, okay? And what you expect to see is you're looking for the price action around it. So you could typically expect that to contain prices. And if it doesn't, and you see price pulling away from it, you can trade it like a support and resistance. So see it like a support and resistance level. And say you were short euro US dollar, not that we will be today because of the FOMC, but say you were, you know there's a big option expiry there at 1.1300 level, you expect profit takers. So you just like, okay, I'll take my profit here. If I was long, okay, I'll take my profit there. Whenever it's over 1 billion, it's significant. We've got a video on it, Jimmy. Just either have a look on the video section, search on our website, or just type a question into underneath one of the videos saying, could you explain options expiries for me? And someone will send you a video. Okay, yeah, good. Yeah, good, Jimmy. Just type a question in. Type a question in like underneath one of the videos. And we'll get that over to you. Just here, just say like, like how do I use option expiry levels? I can send that to you. Okay. Tobias, if people are buying a lot of stocks, will that drive down the dollar? If the S&P 500 affected positive, negative of the US dollar, yeah. If we get yield curve control, quantitative easing, we'll see negative US dollar stocks rising. Carlos, under which scenario the inflation trade could take a break? That would be under the second wave of COVID-19. Can open the opportunity to buy bonds when they are cheap and wait until the Fed buys till it gets to the yield target to liquidate that position. Yeah, there are things that could be done there, Rolando, when you know the central bank is keeping that. Hi, can we swing trade using the daily 4-hour time horizon by conducting? Yes, you can, Mohammed. You can swing trade for sure. And that pound New Zealand dollar outlook was a swing trade there. Yeah, sure, Tobias. Yeah, more swing trading ideas in the future. It's a great way for us to learn. Yeah, it is. It's good. And use the trade ideas, and then they can, even a trade that's looking at a position or a swing can be used for intraday as well. Josim, hi. I think you misunderstood my question regarding the trade ideas. I know very well that nothing is 100% sure in trading, but if I'm to follow the trade ideas, which I'm aiming to do, I of course need to know that Forrest will still think it's a valid trade. Obviously, don't remove the trade ideas. What I meant was, how can I know that you guys still think that particular trade idea is still valid? Everyone would sure appreciate it if there was a green thumb beside the idea or something similar to be sure that Forex still believes in the idea. Just ask us, Jehosim, in the webinar, like today, just ask. And you can even ask in the video section. Here, you could just say, is pound New Zealand's short still valid today, swing trade valid today? So there's some things we can help. Yeah, thanks for the idea. We're constantly thinking of ways to improve what we're doing, Josim. So I'm going to take that on board. And we were talking about the trade ideas just the other day. So we are looking at ways of improving that, and we're trying to think it through so it's most helpful for people. So thanks for that feedback. We're doing a gold buy and a pound Australian dollar short ahead of the FOMC meeting. I I think a gold buy, of all the speculations that you take, I think a gold buy makes sense. But you're looking for yield curve control, some kind of indicator for yield curve control, QE money the same. That'd be strong US dollar negative. So the risk is that you don't get that, and then you're underwater. But you could pull it as soon as the it's gone against you. A pound Australian dollar short ahead of the FOMC meeting. I think a pound Australian dollar short makes sense longer term. Whether I particularly take it before the FOMC, no, I wouldn't. But a gold buy I could see making sense. And in a gold buy, you're expecting some kind of yield curve control, and you're just kind of speculating that it's going to happen. The risk is obviously that it doesn't happen, and then you're quickly underwater. So that's my views on that. Okay, yeah, thank you. I'm just going to check that. Okay, guys, well, that's through the questions now. I want to say thank you very much for a good session again, getting ready for that meeting. Just one question from David. Hi, Giles. Going back to the FOMC tonight or any big event, is it valid to actually view the initial 1 to 5 minute candle reaction as the market analysis in action? The machines will be reading the Fed statement super quick and placing the trades based on the keywords they find. Thus, the market analysis is happening real time. No, because sometimes, David, you get the events faded at the event. So you sometimes get like a reaction to the downside on the news, and then suddenly it flips back the other side. So I wouldn't be looking at the 1 5 minute candle. I wouldn't be looking at the price action. I'll be looking at what's said. That's the key thing. And then you can enter with conviction. How long after FOMC should we wait to enter a trade? Well, you've obviously got the press conference afterwards. So just see it as 2 events. You've got the event and the press conference. So when you know what the Federal Reserve is doing, that can be a reason to enter a trade. If you're more cautious, you will want to wait for the press conference. If it's obvious that the press conference is going to be one way, Amati, then you can enter before the press conference. If it's uncertain and if it's a bit vague, then wait for the press conference, and you might get a move outside of it. The risk is when you get something that looks one way from the announcement, but the press conference reverses it. That's the thing you've got to look out for. So say like there was yield curve control and quantitative easing the same, and then all of a sudden Powell comes and speaks, and it's not quite as it seemed. If it was something like that, that's what you need to look out for. Okay, guys. Thank you all very much, and I hope you all have a very good afternoon, and thank you for attending. Goodbye now.